Hello, Britain. Let's grab a brew and get into it. Right, straight in. Brent crude just pushed past $107 a barrel, up more than 15% in a single day. 15%! That's the biggest one-day jump we've seen in years. And before anyone says this is over there, it isn't. This is your wallet, your commute, your thermostat. Today, we're unpacking the Iran conflict driving this shock, what it means at the pump, and how it filters through to your bills and mortgages. Amira Shah's in the studio. Morning, Amira.
Morning, Jack. Morning, everyone. Thanks. Yes, those numbers are stark. When Brent spikes like this, markets panic because oil is the global price setter for transport and a big input for industry. It doesn't magically stop at the trading floor. It moves straight through to petrol, diesel, wholesale energy, and then, importantly, into inflation figures that affect interest rates and household budgets.
Right, let's go to the forecourt, because people feel this most painfully when they're filling up. Amira, what are we seeing today in pounds and pence?
Over the last 48 hours, we've seen average pump prices rise about 3 to 4 pence per litre. Right now, many forecourts are showing unleaded around 136 to 138 pence per litre, diesel sitting between 147 and 149. And if this trend continues, some areas could push towards £3 a litre by the end of the month.
Right, let's go to the forecourt because people feel this most painfully when they're filling up. Amira, what are we seeing today in pounds and pence?
£3 a litre? Blimey, that's a lot. For most people, that's an extra 3 to 4 quid every time they fill a family car. Tradespeople, delivery drivers, taxi drivers, we're talking hundreds extra a month for some of them. You feel that straight away.
Exactly. To put it into a simple household example, a 50-litre fill that might have cost about £60-odd could jump by £3 to £4 immediately, and that's per fill. For someone commuting 5 days a week, the monthly hit adds up quickly. And then there are second-order effects, higher transport costs for goods, which feed into food prices in the shops.
So it's not just drivers paying more. Everything that gets moved by road or sea gets more expensive. Okay, next, home heating. People are worried about their energy bills for winter as it is. What's happening with gas?
Gas prices have risen sharply, roughly an 80% jump compared to recent lows since these strikes and the escalation began. That feeds into wholesale electricity prices and, crucially, places strain on the off-gem price cap. If wholesale prices stay elevated into July, that price cap reset will reflect much higher costs. We're talking potential household impacts north of £500 extra a year if conditions persist.
500 quid? That's not small change. That's a couple of months' food shopping for a family. People are already deciding between heating and other essentials. What levers are left? Can the government step in?
There are limited short-term levers. The government can offer targeted support, direct payments, council tax rebates, that sort of thing. But large subsidies on energy are expensive and politically tricky. The source material flagged emergency talks with North Sea operators. Boosting domestic production helps over the medium term, but doesn't solve an immediate global shock. And remember, the UK is still effectively a net importer in many fuel forms, so global prices dominate.
Yeah, and we heard mention of Chancellor Rachel Reeves calling in, folks. Look, people will expect action, but there's only so much Westminster can do overnight. Meanwhile, these price rises feed straight into inflation, don't they? Give it to us straight. How bad could it get?
Yeah, and we heard mention of higher oil and gas can add between 0.5 percentage point to a full percentage point to headline inflation, depending on how persistent the shock is. The OBR has already cut growth forecasts. The source material notes 2026 now seen at about 1.1%. And this kind of shock increases the chance of what economists call stagflation, higher prices alongside weaker growth. For households, that's a nasty combo. You get hit by price rises while wages and job prospects lag.
Stagflation. That's a hard word and, more importantly, a hard reality. So, Bank of England, more rate rises, or are they stuck?
The bank tends to respond to inflation, not geopolitics per se. If inflation edges higher and becomes persistent because of energy costs, the Bank of England is likely to keep rates higher for longer. That means mortgages stay expensive, fixed-rate deals reset higher, and the cost of credit for firms, which feeds into hiring decisions, stays up. The short version, higher costs for households and more pressure on businesses.
So it's not just your weekly shop and your tank, it's your mortgage, your job security, the small businesses up and down our towns. Amira, we've had a lot of political spin already. I mean, we've got Starmer under pressure on foreign policy. We've had international criticism, even from, weirdly, Trump joining the commentary.
Politics will always colour the conversation. The immediate reality is, policy options are blunt. Short-term targeted support can help those most exposed: low-income households, pensioners, people on fixed incomes. Longer-term, investments in energy security and renewables help to blunt future shocks. But none of that changes the fact that this shock came from geopolitics, and global markets react quickly.
Let's get personal for a minute. You're an analyst, you work with models, but what would you tell someone listening right now who's feeling the squeeze? A commuter, a parent, a small business owner?
3 practical things. 1. Plan short-term. Look at your direct bills and see if you can switch to cheaper energy tariffs now, or contact suppliers if you're worried about arrears. 2. Cash flow. Build a small buffer if possible. Move non-essential payments where you can. 3. Think in terms of behaviour. Can you reduce non-essential journeys, combine trips, or use public transport for some commutes? Those sound small, but multiplied over a month, they ease immediate pressure. Also, if you're a small business, have honest conversations with suppliers and customers about rising costs. Transparency helps.
Good, practical. I want to throw a couple of listener scenarios at you, Amira, and you react. Scenario 1. A self-employed courier in Leeds doing 200 miles a week. What are we looking at?
If petrol or diesel rises to around £3 a litre and you're doing 200 miles a week, that could mean an extra £200 to £300 a month in fuel costs alone, depending on the vehicle. That's significant enough to wipe out margins for many couriers. They'll likely try to pass costs to customers, but in a competitive market, that's tough. So we could see tighter margins and, unfortunately, some businesses cutting hours or rates for drivers.
And scenario 2, a family in Bournemouth on a fixed-rate mortgage coming up for renewal later this year.
For them, the immediate shock is energy and travel costs. The secondary hit is if the bank holds rates high because of inflation. Mortgage renewal offers could be noticeably higher than their current rate. That's a direct hit to monthly household budgets. They need to review options early, talk to brokers, consider fixed terms if possible, and rework budgets to allow for a higher monthly payment. It's about preparation.
Preparation. That matters. Okay, let's talk about the wider jobs picture. Are we looking at layoffs, or is it too early to say?
It's a risk. Higher energy and input costs squeeze business margins. Some sectors, transport, logistics, hospitality, feel it more acutely. If consumption slows because households cut back, businesses will see lower revenues and may respond with hiring freezes or redundancies. We may not see mass layoffs immediately, but the risk grows over quarters, especially if growth forecasts stay weak.
Right. Look, folks, this is getting real and quick. We want you to tell us how this is hitting you. Send a 40-second voice note with your first name and location. Tell us what you're doing differently, what you're scared of, or if you've already had to make a tough cut. We'll play the most telling messages on the next show and keep things grounded in what's actually happening on Britain's streets.
Please do send them. Hearing from real people helps shape the story and the policy conversation. We want to know which groups are being hit first and hardest.
Before we close, a quick recap, because it's easy to let the headlines blur. 1. Brent crude spiked above $107 a barrel, up over 15% in a day, driven by the Iran conflict. 2. Petrol and diesel up 3 to 4 pence per litre in 48 hours, unleaded around 136 to 138, diesel 147 to 149, and a risk of £3 a litre if the trend continues. 3. Gas prices are up roughly 80% on recent levels. That risks pushing the Ofgem cap up and household bills up by perhaps £500 a year if sustained. 4. Higher energy feeds into inflation, maybe adding half to 1 percentage point, which makes the bank likely to keep rates elevated, hurting mortgages and loans. 5. Politics can try to cushion this, but short-term options are limited, and we need to think about both immediate support and longer-term energy security.
And if I can add one last practical line, if you're worried about bills, contact your supplier early and seek advice from charities or your local council. Don't wait until arrears mount. There are often small, immediate steps that can prevent bigger problems later.
Absolutely. Okay, send those voice notes. 40 seconds, first name and location. Tell us what's changing for you. We'll bring you back the best of them next time. Thanks, Amira. Really clear, calm and practical. And everyone listening, look after yourselves. This is one of those moments where small choices matter.
Thanks, Jack. Take care, everyone. And please share these stories. And please share these summaries.
UK Pulse, cutting through the noise. See you next time.